The silver market just witnessed one of the most dramatic volatility events in recent history. The price surged to a new high of $83.71 at the open, only to decline $9 in a matter of hours, forming what technical analysts call a shooting star candle, a pattern that traditionally suggests a potential reversal. Retail traders are concerned. Financial media is running headlines about market corrections. But here's what should get your attention. While the paper price on COMEX moved to 74, bullion dealers maintained their premiums relatively steady. The street price, what you actually pay for physical metal, held much more firm. That divergence tells an important story about market structure. Let me be direct with you. What you witnessed may not have been a typical market correction. It appears to have been a liquidity event executed during the thinnest trading window of the year, what market participants call Ghost Week, which may have been designed to trigger stop-loss orders on leverage long positions and create entry opportunities for institutional capital, preparing to deploy in January. And if you understand the pattern I'm about to show you, this violent shakeout may not signal the end of silver's rally. It could be a liquidity flush that historically precedes significant moves. I'm going to show you a pattern that has appeared consistently throughout market history. Once you see it, today's shooting star candle may transform from a reversal signal into a different kind of technical event. It's called the four-stage speculative market cycle top formation, and it has appeared in major commodity markets from oil in 2008 to Bitcoin in 2021. Right now, we may be watching stage 4 execute in silver, institutional liquidity events, and retail position adjustment, the phase where large capital participants use volatility strategically before potential final moves. The shooting star may not be the top. It could be the volatility that historically precedes climax phases. Let me define the mechanism, because understanding this four-stage cycle helps distinguish between being caught by volatility and recognizing it as a potential tactical opportunity. Stage 1 is accumulation during price stabilization. The cycle begins when a commodity appears structurally undervalued due to years of price management through paper markets, futures, derivatives, and leveraged instruments that can influence pricing. During this stage, sophisticated capital may accumulate physical positions, while paper markets keep prices relatively stable. Retail participation is typically minimal because prices appear stagnant. Public sentiment often suggests the commodity has limited potential. This stage can last years or decades, characterized by consistent sentiment that the asset lacks momentum. Stage 2 is breakout and momentum development. Something changes, whether industrial demand growth, supply considerations, currency concerns, or geopolitical developments, that shifts market dynamics. Prices begin rising. Technical breakouts occur. Retail participation increases as momentum builds. During this stage, paper and physical markets generally track relatively closely, and various forms of market participation are readily available. Public narrative shifts from a skepticism to cautious interest. Institutional positioning during this stage may involve continued physical accumulation, while adjusting paper positions, allowing prices to appreciate in a more measured manner. Stage 3 is acceleration and leverage expansion. The commodity enters rapid price discovery. Retail enthusiasm drives increased leveraged long positions through futures and margin trading platforms. Open interest on exchanges grows substantially. The ratio of leveraged paper positions to physical delivery capacity reaches elevated levels. Media coverage intensifies, attracting participants who enter at progressively higher prices using increased leverage. Institutional positioning during this stage becomes more nuanced. Sophisticated participants may reduce paper exposure while maintaining physical holdings, recognizing that leverage buildup typically requires eventual adjustment. Stage 4 is institutional liquidity events through strategic volatility. This is when significant volatility events occur. The commodity reaches a psychological price level or technical milestone that attracts substantial retail participation with elevated leverage. Then, during a period of reduced liquidity, holidays, lower volume sessions, overnight markets, coordinated activity in paper markets can trigger stop-loss cascades. Prices move dramatically, affecting leveraged positions and creating concern. Retail participants may exit at disadvantageous prices. But here's the important observation. The physical market often doesn't follow the same pattern. Premiums may remain elevated. Delivery considerations don't necessarily ease. The price movement concentrates in paper markets, suggesting it may be a liquidity event rather than fundamental distribution. Technical patterns, like shooting stars, form during this stage, which can influence retail perception, while sophisticated capital may use the volatility to adjust positioning before potential subsequent moves. Now, let me show you this pattern through two historical cases where significant volatility shakeouts during major market cycles appeared to signal tops but actually preceded final substantial moves. The first is crude oil in 2008, which demonstrated this four-stage pattern with a major liquidity event in May 2008 that appeared conclusive, but preceded the final surge to $147. Stage 1 was oil's consolidation phase from 2001 to 2004. Oil traded between $20 to $40 for years, while institutional participants quietly built positions through various instruments. Paper markets maintained relatively stable pricing. Retail participation was limited. Public narrative suggested oil would remain accessible due to supply availability. Stage 2 was the breakout from 2004 to 2007. Oil moved above $50, then $70, as China's industrial growth drove demand and supply considerations became more apparent. Retail participation increased through commodity funds and futures. Paper and physical markets generally tracked together. Institutional positioning involved continued position building while managing exposure to allow price appreciation. Stage 3 was the rapid acceleration from late 2007 to May 2008. Oil surged from 90 to 135 in months. Retail enthusiasm drove substantial leveraged long positions. Open interest on NYMEX crude futures reached very high levels. Media coverage was extensive. Broad retail interest in oil exposure developed. The ratio of paper positions to physical delivery capacity became notably elevated. Stage 4 was the May 2008 volatility event. On May 5, 2008, oil formed a significant shooting star daily candle, moving to 126 intraday before declining to 116s, a $10 swing that affected numerous leveraged retail positions. Technical analysts suggested this might be the peak. Retail traders reduced positions. Financial media reported potential market correction. But here's what subsequently occurred. Oil consolidated for approximately 3 weeks, then launched a final move from $120 to $147 in July 2008, the actual peak. The May shooting star wasn't the reversal. It was a liquidity event that adjusted positioning before the climax. Capital that participated in the May event repositioned for the final phase. The second case is highly relevant, Bitcoin in 2021, which showed very similar mechanics with a significant April volatility event that appeared terminal but preceded the actual November peak. Stage 1 was Bitcoin's consolidation from 2018 to 2020. After the 2017 cycle, Bitcoin traded between $3,000 and $10,000 for an extended period. Institutional capital built positions through various vehicles, while retail participation was limited. Public narrative suggested Bitcoin might have limited further potential. Stage 2 was the breakout in late 2020 to early 2021. Bitcoin moved above $20,000, then $40,000 as institutional adoption increased and retail interest returned. Leverage through various platforms expanded substantially. Derivatives and spot markets initially tracked relatively closely. Stage 3 was the rapid acceleration to $64,000 in April 2021. Retail participation reached elevated levels. Leverage ratios hit very high levels with substantial open interest across derivatives platforms. Media coverage was continuous. Widespread retail interest and crypto exposure developed. The Coinbase listing marked a period of peak retail enthusiasm. Stage 4 was the April 18, 2021 volatility event. Bitcoin declined from $64,000 to $47,000 in a single day, a 26% move that affected over $10 billion in leveraged positions. The daily candle appeared as a textbook shooting star. Technical analysts suggested the peak might be established. Retail participants exited with concerns. But here's what the historical pattern would have suggested. Bitcoin consolidated for approximately 6 months, then launched a final move from $40,000 to $69,000 in November 2021, the actual cycle peak. The April shooting star wasn't the reversal. It was a liquidity adjustment before the climax phase. Participants who recognized this pattern had repositioned by October for the final phase. Both historical cases show similar mechanics. A significant shakeout during a major cycle that creates bearish-appearing technical patterns affects leveraged retail positions and creates concern but precedes final substantial moves because the event was a liquidity adjustment rather than fundamental distribution. Now, here's why today's silver shooting star may follow this historical pattern and why the 83.71 surge to 74 decline could be Stage 4 liquidity adjustment rather than a cycle conclusion. Stage 1 was silver's extended consolidation phase from 1980 to 2020. Silver was range-bound through various market mechanisms, trading between $5 and $20 for decades, while certain institutional participants built physical positions. Retail participation was relatively minimal. Public narrative often suggested silver had limited monetary or investment relevance. Stage 2 was the breakout from 2020 to 2024. Silver moved above $20, then $25, then $30 as industrial demand from solar panels and electronics combined with monetary considerations drove prices higher. Retail participation increased through online communities and ETF activity. Paper and physical markets tracked relatively closely initially, though premiums began widening somewhat. Stage 3 was the rapid acceleration from late 2024 to December 2024. Silver moved from 30 to 83.71 in a compressed time frame, a substantial percentage move. Retail enthusiasm drove increased leveraged long positions through COMEX futures and margin trading platforms. Open interest expanded significantly. Media coverage intensified. Widespread retail precious metals interest developed, with many expecting immediate continuation to 100. The ratio of paper positions to registered COMEX inventory reached historically elevated levels. Substantial paper claims per ounce of readily deliverable physical metal. Stage 4 is the volatility event we observe today. During Ghost Week, the period between Christmas and New Year when institutional participation is reduced and liquidity is at annual lows, the price moved to 83.71 at the open, potentially triggering numerous retail stop orders and option positions, then declined $9 to $74 within hours. Many leveraged long positions were affected through stop-loss mechanisms. The daily candle formed a classic shooting star. Technical analysts across various platforms suggested the silver rally might be concluding. Retail traders expressed concern. But here's the important market structure observation. Bullion dealers maintained their premiums relatively steady. When COMEX silver moved to $74, the street price for physical silver coins and bars remained substantially higher, in the 82 or 85 range for many dealers. Platforms like Apimex, SD Bullion, and Money Metals maintained elevated premiums. Delivery considerations didn't materially improve. The physical market showed significant divergence from the paper price movement. That means a characteristic signature of a paper market liquidity event. The volatility occurred primarily in leveraged derivative markets, while the physical market reflected different supply-demand dynamics, suggesting continued tightness. Here's the potential mechanism. Trading activity during reduced liquidity periods can have amplified effects. During Ghost Week's thin trading, coordinated activity in paper markets can trigger stop-loss cascades more easily. Many retail traders likely had a protective stops positioned below recent highs. Price movements that trigger those stops create forced position liquidation that generates liquidity, sellers providing contracts that larger participants can acquire at more favorable levels than would be possible during normal liquidity conditions without significant market impact. Let me check the indicators against the historical pattern. Did silver experience extended price consolidation during an accumulation phase? Yes, 1980 to 2020 with range-bound pricing. Did silver break out and accelerate substantially? Yes, $30 to $83 in a compressed time frame. Did retail leverage reach elevated levels? Yes, COMEX open interest and retail options activity at very high levels. Did a significant shakeout occur during minimum liquidity, creating a bearish-appearing technical pattern? Yes, Ghost Week shooting star candle. Did the physical market diverge from the paper price movement? Yes, dealer premiums held relatively firm, suggesting the decline was concentrated in paper markets. The historical pattern appears present. Stage 4. Characteristics are observable. Here's what mainstream financial analysis may emphasize differently. Media coverage will likely frame today's price action as profit-taking or technical reversal or correction. They'll reference the shooting star candle as technical confirmation. Retail participants may interpret this as a signal to remain cautious. That psychological response is often an outcome of volatility events. The alternative interpretation based on historical patterns is that large capital participants may use volatility strategically to adjust positioning before potential subsequent phases, what some analysts call the January effect. Here's what historical patterns would suggest for the coming period. January often brings substantial capital flows to commodity markets as pension funds, institutional portfolios, and ETFs conduct year-start rebalancing. Today's volatility affected leveraged positions. Retail leverage has been reduced. The physical market remains structurally tight. COMEX registered inventories are relatively low compared to paper claims. Industrial demand considerations continue. Solar panel production growth alone represents substantial ongoing demand. The technical setup, based on historical patterns, could favor subsequent upward movement because leverage positions that might have been vulnerable during such moves have already been adjusted. The shooting star candle in major market cycles, based on historical analysis, often isn't the cycle peak. It's frequently a volatility event that precedes climax phases. Participants who recognize this pattern distinction may interpret such events as position adjustment opportunities rather than exit signals. If you held physical silver through today's volatility, you experienced the event differently than leveraged participants. Your metal retained its physical characteristics and street pricing showed relative stability. If you held leveraged positions or margin traded, the stop-loss mechanisms would have affected positions, potentially at disadvantageous levels. That's an important consideration. In major market cycle climax phases, volatility can disproportionately affect leveraged positions, and physical possession provides different risk characteristics. Pattern recognition in market history provides important context, and historical patterns suggest that volatility events like today is shooting star may not signal cycle conclusions. They often represent liquidity adjustments before final phases. The technical environment may actually be more favorable for subsequent upward movement, because leverage that might have been vulnerable has been reduced. Consider your positioning carefully and make decisions appropriate for your risk tolerance and investment objectives, because major market cycles often include significant volatility that affects different types of market participation very differently.